Well, not sure what happened there. The webinar ended on its own. I did not end it, but it ended it for me. So I'm not quite sure how we did this. So again, one more time, if you can hear me, just to make sure we're all back on the queue, we'll catch up and we'll get going back where we left off here a moment ago. So please let me know if you can hear me, and we'll see if we can get going. Okay, so we're back on. Sorry we lost you guys there. Let me get the slides back up, and let's get back going again. And we may have a couple more guys show up here in just a moment because we lost everybody. Sorry about that. Don't know what happened. It just said the session ended. Didn't think I clicked on anything that did that, but maybe I did. All right, so as we said, okay, month one, we're going to check the readiness of our company. And by that I mean what we're going to do is we're going to assess the company to make sure that the company is ready to raise funding. We're going to talk to everybody on our team and our investors to make sure that they're okay with us raising money. We're going to go to our attorney and tell them we're thinking about raising money and make sure they're on board with us, and any input they have we're getting out of this process as well. In month two, we're going to prepare the company itself. And by that I mean we're going to build key documents you need for raising funding. And those documents include an executive summary, a one-page version of your deal or your company and what you're doing here for raising funding, and something that you can hand to anybody. We have templates if you need those to help fill one out, but basically you're not having anybody sign non-disclosure agreements, but it's something that tells enough about the company and the product and the fundraise and so forth that you can hand it to a prospective investor, and they can read that and make a decision they want to learn more or no they don't. The next is you need a slide deck, 12 to 15 slides about your company, something you can discuss in 10-15 minutes with an investor over a coffee or in a presentation room itself. And then you need financial statements. Typically you need the historical financials and you need your projected financials for the next 5 years. And these are typically detailed financials. They have every product, every expense, every cost, every channel in the system itself. And then finally, what I always recommend you do at this stage is start working on your due diligence documents. These are documents that your investors are going to want to see should they decide that they are interested in investing and now they want to understand better all the details of the company. And so these things, and we'll look at them in more detail, include things like the legal entity, any intellectual property, articles of incorporation, contracts, tax statements, all the usual things that an investor might want to see to learn more about the business from a financial and legal perspective before they make a decision. And the reason I say we should start gathering these documents together now is every time I make an investment and I start the due diligence process, I have to wait at least 30 days before the entrepreneur is able to pull these documents together. And it appears that these documents are spread not all over their office but all over the country. And so that's why you might want to start pulling these documents together now to see what it looks like. Also, what you want to do is start to fill out your team with a board of advisors. And as we said in the last couple of slides, a board of advisors is someone that is attached to the company, but you're not compensating them, but you're not asking them to do heavy work. What you do is you make a list of things you need help with, gaps you might have on the team. At this stage, you don't have enough funding to pay everybody to hire everybody that you need. So what you do is you hire the core people, and then the other things that need to be done, you simply make a list of those and ask people to be board of advisors. And whenever you list your management team, you list those board of advisors and talk about how they're helping you with this aspect of the business or that aspect of the business. And people do that sort of work because in the future there may be a role with them in the company that is compensated, and they're basically helping out on a pro bono basis with a thought that in the future they can either give back now or they might have a position with the company later. In months 3 and 5, what you want to do is prepare the investors. Now, what most people do at this stage is they go out and they start pitching, saying, I need to raise funding, here's my deal. But what I'm coaching you to do is before you go raise funding, you go to the investors and you start to find who might be a potential investor, and you put them on a prospect list. You start asking your friends and family and everybody you know who are potential investors and put them on a spreadsheet. And your goal is to put 10 new investors each month on your list. And when you get those investors on a list, you call them up and you ask to meet with them because you have a deal that's coming up. And you want to go out and you want to introduce the deal to them. And so what I always recommend you do is sit down with the investor and say, I'm not raising funding today, but in 3 months I will be raising funding, or 4 months I will be raising funding. Let me tell you more about what we're doing. And after you show them what you're doing, you basically say, now in 4 months I'll be back and like to show you how well we've done and get your ability to sign up on this deal to invest and so forth. May I keep you on the list and keep you informed of our progress. So what we're trying to do now is we're trying to educate the investor by giving him updates and giving him the pitch, but we haven't started the fundraise just yet. We're in advance of the fundraise starting to prepare investors by showing them a little bit about what we're doing. And then what you do with all the investor prospects is you start sending out monthly updates, and these need to be personalized for the investor. They need to say, Dear Bill or Dear John. They can't just say, Dear Investor. Or worse, they just say everybody. You know, you have to put the name of the person and make it a little bit customized, and then you actually start sending out short updates about how you're doing on your deal. You're hiring people, you're gaining customers, you're shipping products, you're generating leads, you're signing up partners. All of these are good things that you use to educate your investor on your deal. And so what you're trying to do is demonstrate that you achieve milestones. You're making steady and consistent progress on your business, and that's what the investors always want to know. And so the reason we're doing this in advance of actually raising money is most investors put you on the 3-month watch schedule, as we said before. So why not go ahead and start that watch schedule sooner rather than later? Months 3 to 5, we'll have them watch me, and I'll educate them on what we're doing. And we'll have 50 or so investors probably educated on this process by the time we get to the actual fundraise. So in months 6 to 9, we go back to those investors. You saw them 3 months ago or 2 months ago, and now you go back and you say, I am ready to raise funding. Let me show you where we are right now in this process. And you go and you pitch the investor in a formal way, and as you're doing this, you start to look for what we call the lead investor. This is the first guy who's going to put funding into your deal. And I often get entrepreneurs coming back to me saying, oh, I'm ready to raise funding and I've got 5 investors, but nobody wants to be first. Everyone's waiting for someone else to be first. And so what we need to do early on is start to look among all the investor prospects and identify someone who might be a lead investor who might make the effort to go forward with first. And so as we're pitching these investors, we find the lead investor. What we often do is bring someone that will be a lead investor and give them a better terms than other people. We tell them, if you'll be my lead investor, and it's not something you offer to just everybody, but to key people, you say, I'll give you a better stake, I'll give you additional warrants or grants or something that will make it worth your time to be the lead investor, and you compensate them. And the reason you have to compensate them is that lead investors are taking a risk. The first person in could be the only person in, and investors know this, which is why they hang back. Many investors are doing the smart money thing, and the smart money thing is to be the last one into the deal. Not the first one into the deal, the last one into the deal, and which is why it's often the case that you have investor interest but no one who wants to go first. And what you need to do is make sure you compensate them for the time and effort they're going to be putting into this deal and give them an incentive or reason to take a little bit of a risk there. So after we have our investors signed up, for the most part, they say they want to do this, we in months 10 to 11, you'll find that after you get the lead investor closed and you get a few more investors closed, it will start to become easier to close investors because more and more risk is off the table. You've advanced the company further along. You're continuing to make progress in your deals and so forth. You can then close the remaining investors. So you're just inviting other investors to join the round. They don't have to do as much due diligence. They don't have to lead the documentation. That part has already been done. You just simply have them go in and sign the documents, and they do their due diligence, but they're pretty much not having to do everything. And then it'll take you about 4 to 6 weeks to actually sign all the documents and close it out. It takes the lawyers a little bit of time to put the documents together. It takes time to get around to everybody, work into their schedule and have them sign the documents and so forth. And we get to the last month, and after the deal is closed, 99% of entrepreneurs out there just immediately drop all the investors who did not sign up. They just forget about them. They take them off the list. They don't communicate with them anymore. But what I recommend you do is keep that investor prospect list going. You may not be sending out monthly updates anymore. You may be sending only quarterly or every 6 months or even annual updates, but keep the relationship with those investors. Almost more than half of all companies who go out to raise funding will go out to raise a second round of funding. Typically 18 to 24 months after you close your first round of funding, there will be a need for additional funding. And if you maintain the relationship with those investor prospects, you will be in a position to go back to them and say, well, we talked last time, you didn't invest, but we're looking for another round of funding. Let me show you how far we've come since we talked to you last time. And that often impresses investors to see how many milestones you have accomplished, how far the deal has gone, and then they will be much more interested in investing because they've got a little bit of history. They've been on the journey with you, so to speak, for a while, and now they understand better who you are. You have a stronger relationship. And they may be more risk-averse investors who are interested in investing in a future round rather than the early round. So the idea is to keep those investors with you as you go through the process. So as we said before, let's go ahead and type in any questions you have, and we'll put those out there for everybody to have. So as we said before, we're going to record this session, and we're going to send you that along with a copy of the slides. So tonight, after the recording finishes, I will upload it to YouTube, and I will send you a link to that video as well as a PDF of all of these slides. So they will be there for you as well. If you have any other questions, feel free to go ahead and type them in. And other than that, let's move on to the next module. Assessing your readiness to raise funding. So are you ready? So when most entrepreneurs come to me to raise funding, they basically say, do I need funding? And if the answer is yes, well, then they go off and ready. But the question you should be asking is, am I ready to raise funding? And so a checklist of things to consider before you go raise funding is the following. Number one, you need to have a legal entity already established. A number of companies, 10 to 20% of them that come to me, they're out doing great things, but they haven't actually established a legal status. And so we have to go get a legal structure set up. And then most are formed under an LLC. And in the state of Texas, most investors are not interested in investing in LLCs. Some are, but most want to see a C corporation. They don't want to see an S corporation. An S corporation limits the number of investors and can be problematic later. They want a C corporation. And so if you have an LLC, you may need to talk to your attorney about switching it over to a C corporation. And you don't want to go to a C corporation on day one that you start a business because there are additional costs and taxes that come with the C corporation. But if you're raising funding, it's the deal structure that most investors enjoy. And you don't necessarily need a Delaware C. People talk about a Delaware C being the best one possible, but the reality is a Texas C is only just slightly behind a Delaware. And if you're raising funding in Texas and working in Texas, a Texas C is good enough. If you're going abroad, you're going to the rest of the U.S., you plan to raise money in California or New York, well then a Delaware C may be something you want to consider before you go in because there is a cost to doing this. Next question you need to ask before you go raise funding is, do you have a product in the market? Investors almost universally require you to have a product that some customer has tried and paid something for. You may not have a lot of customers, but you have a product that's in the market that people are working with, using, buying at some level. And if you can get to the market within 3 months, well then maybe it's something that some investors would consider as well. And do you have customer interactions with your product? If you're at the beta level, people are trying it out, the investors would want to go and talk to those customers to see, are they're using the product, are they happy with it, are they planning to buy it, how much will they pay for it, those type of questions. Under sales, you need to have sold a few units. And always talk about don't just give units away free. Try to get the customer to pay something for it, even if it's a greatly discounted price, because that means a great deal to the investor. If someone put money on the table, even if it was discounted, that still shows interest. It still shows that they're going to use the product, and it means a lot more than just I have people testing it out. And what they're trying to figure out is, does the product work? And if they go to the customer says, I'm using it, it works well, they check mark that box, and that's great. The other thing they're trying to figure out is market validation. If someone puts money on the table, it means there's something of a market there. We may not know how big it is or how expansive it is, but it does prove that there is a market at that point. Next thing to consider is, have you identified the business model? It's often the case with software that entrepreneurs are shipping software, or they're giving it away free, or they're doing something of that nature. But the question the investor has is, how do you make money? And you need to come in with a fairly detailed answer of how that really works. And so you need to be able to cite some metrics. For example, what is the cost of customer acquisition? So per customer, how much sales and marketing goes into it on average before the customer buys the product? And then product development costs. What did it cost to develop that product, and we'll keep developing the product in order to make it successful? And is there any profitability out of it at the end of the day? Next question to ask is management team. Do you have a complete management team? And in the early stages of a business, a management team consists of at least 2 people, and those people are someone building it and someone selling it. And it's often the case when I go talk to a startup that they've got 2 people building it and nobody's selling it. And let me tell you, investors can spot this a mile away. And this is a problem. If 2 people are building it and no one is selling it, it means we're going to have a great product, but we're going to have very poor sales. And so what you need to do is demonstrate that you have both sides of that equation covered in some way or another. And then under financials, you need to make sure you have some financial projections developed that you have some level of confidence in. Oftentimes people are building financials and they're telling me, if not directly, indirectly, they're telling me they have no confidence in their numbers. And that means we're just a little bit early on. We haven't proven our business model. We haven't proven our sales model. And if you prove out some of the more basics, well, then the financial projections should be coming out with a little bit more confidence. And some of the statements that you'll need is you'll need an income statement, you'll need a cash flow statement, and you need a sales forecast. Balance sheets are important to some, but these are the 3 things that most people, most investors are looking at is revenues and expenses coming in, how you're going to manage cash, which is keying at this stage, and what kind of sales pipeline do you have. What customers are in the pipeline, how long does it take to go through the stage of interest to trying it, to buying it, to becoming a repeat customer. And to the extent you have a predictable process, you'll get more traction with investors. And then, as we said before, we need to have some due diligence documents, which include articles of incorporation, patent filings, all your financial records, taxes, payroll taxes. Are you paying your payroll taxes is a big question as well. And then the next one is, have you talked to your attorney? You got the proper legal entity, and do you have the proper fundraising documents ready to go for this as well? And then your team and investors, like I said before, have you talked with your team? Have you talked to current investors? I often am asked by entrepreneurs who want to raise funding to look at my deal, and then when we start to get into it, it turns out they haven't asked their previous investors, and this can be a source of contention later in the process. So let's stop there and ask, what questions do you guys have so far? Okay, well, let's move on from here. So this is our 3rd module. We're pretty well on time for track for finishing within our 1-hour window here. And it talks about how to write an executive summary. So our first document that we need to provide the investor, and you can actually use it for a wide range of things. You can use an executive summary for to show employees what you're doing, or prospective employees, partners, suppliers, vendors, and other people who want to know more about your business. You can use the executive summary for that as well. But we're going to gear this one a little bit more toward investors. And essentially, it's a one-page version of your business. And it's non-confidential information. In other words, you're going to hand this out freely to anybody that's appropriate to read it, but it gets passed around. Realize that you can't control who reads it. But most investors at this stage are not signing confidentiality clauses, and so what you want to do is set up the exec summary so you don't give away any trade secrets or anything else you don't want out there. And one of the most important things to put on it is your contact name and details. 50% of all exec summaries I receive have no one's name and phone number on it. I may think it's the greatest deal in the world and want to go and invest, but I have no way of contacting this guy. And so you want to make sure it's easy for people to contact you, because you're trying to solicit responses, generate interest, have them pass it along to other people that might be of interest. So let's look at the key elements that you put on your executive summary. Step one is the problem the company solves. It is very helpful to the investor to understand your deal if they kind of understand first what is the problem, and then later what is the solution. Now, the problem has to be a large problem. It has to be a multi-billion-dollar problem. It has to cost people a tremendous amount of money or time at some level. The problem must be pretty specific. It can't be general or generic. It has to be something that we can really figure out what it is and how we're going to solve it. The other thing that I always like to put out there is make sure you use numbers. The more numbers you put in your exec summary and presentation, the more concrete your proposal looks. It's not just generic or qualitative. There's some real quantitative numbers, and those also help make you look more like the expert because you know the numbers are related to your business. The next is you describe your product and service. And the key here is you want to focus on your core product and service, not every product extension or module or feature, but just focus on the core product. It's often the case entrepreneurs want to impress the investor with the richness of opportunity in their space by talking about all the other products they could develop and all the features, but this tends to confuse the investor rather than enhance the presentation, because they want to see real focus. They want to see a lot of energy going into one or two products as opposed to being diffused across a wide range of things. And of course, you want to avoid too many details on how it works. In most presentations, entrepreneurs will spend easily half or more of their time talking about the product, but realize the investor is not your customer. They're not buying the product. Yes, they want to know what the product does, but they want also equal weightings into the business aspects, such as target market and the competition and the other aspects of the business, in addition to the actual product itself. The thing that the investor is looking for is what economic benefits does the customer get from the product. It reduces our cost by 30%. It increases our productivity by 2x. It increases our time to market by five times. These are the kind of things that investors are trying to figure out, is how valuable is the product to the customer, and if you can put it into some quantitative numbers, it's very impressive as well. So let's look at the competitive advantage. It's often the case that entrepreneurs will just tell me verbally what a competitor is and how the entrepreneur's product is better than the competition. And it can be a little bit convoluted when you get 4 or 5 competitors with 5 or 6 products out there. So what I always recommend is make sure you use a table or a matrix in which you list down the left-hand side your company and then the competitors, and then across the top the different features upon which you compare yourself. And of course you're getting the big green check mark for all of those items, and the competition is getting some green check marks, but mostly they're getting big red X's. And that kind of structure works very well because you can easily show off 4 or 5 key advantages of your solution over the competition's, and the investor can get the big picture as to where you're competitive and who you're up against as well. You also want to put in direct competition as well. such as the customer not buying anything or doing it themselves as typical examples. And then next is let's look at the target market. And so when you look at the target market, you want to show 3 views of it. View number 1 is you want to show the total available market. This is anyone, anywhere who could ever use your product. And of course, that's a big number and a big potential space. The next drill down is to what's called the serviceable market. And this is really the target market you're trying to hit. You made the product for a certain group of people, and this is who we want to talk to. And you want to put down the size of that market and the growth rate as best you can figure those out. But then what's important is the third view of it, and this is what I call the beachhead market. And it's the first 20 customers you're going to sell to when you go to market. And the idea is the serviceable market is usually a big market as well. And what the entrepreneur wants to figure out, or the investor wants to figure out, is where are we going to start and get initial traction. And if you can name the top 20 customers that you want to go hit, and you're already talking to 15 of them, well, that shows you have traction in the marketplace. It shows you have focus, and it shows you know how to get out there as well. And like I said before, show the size and growth rate of each, and it again demonstrates that you're the expert in your market segment as well. Next is you want to show the business model, show how you generate revenue. Now, in some cases, if you're selling industrial products or medical devices, it's pretty clear. You have a product, it's sold for a price, and that's what there is to it. But I often find with especially software deals that the business models can be quite complicated. They've got 3 or 4 revenue streams. You're giving away the core product for free, and then we sell the lead somewhere else. And so it's worthy of a discussion to show how you actually make money, especially if you're using a freemium model, which is we're giving away something free up front, but we're selling something later on the back end. And then also show where you invest money in the model. At what point do you have to provide a service or spend money? And then what you're trying to divine out of it is 2 key metrics. So what at the end of the day is the cost of customer acquisition, and then what is the value of that customer for the lifetime? Especially if you're in a recurring revenue model, how long does that customer stay with you? How easy is it for them to switch? What's the average length of stay by current customers? These are the kind of numbers that we're trying to get to. And if you end up with a very complex business model, then what you might want to do is just draw out a case study. I'm selling to an XYZ customer. You don't have to mention the name. They paid this much for the product. That gave these services. It cost me this much to support them, and I get this kind of profitability out of it. And it can make it a little bit clearer as well. Also, when you go through your exec summary, you want to talk about your sales model. And basically, it's your sales channel. Who's out selling your product, or what tools do you use? Are you hiring people and they're selling it direct? Do you have a distributor or a value-added reseller that sells your product for you? Or are you selling it on the web and you're selling it direct, but you're selling it through the internet? And is there some other channel you might be, maybe you're designed into somebody else's product, and this is how it goes out to the marketplace. Also, you want to talk about the intellectual property. Discuss your patents, your trademarks, and your trade secrets and copyrights itself. And what's key here is to show what has been filed and when was it filed. So if you filed a provisional patent in May of this year, that's fine. If you filed a design patent in November of this year, that's fine too. The investor's just trying to figure out what has been filed, when has it been filed, because that tells them where you are in the process. And if you filed it a while back and you now have what are called office actions, and that means the patent office has looked at it and has given you a response. We think it's going to go forward. You're free to operate. We don't find any conflicts. We're looking at this further. That's good news to share with the investor as well. Also, you want to show the management team. You want to show the top management team, the C-level people, not everybody in the company. And the key things that you want to pull out is the number of years of experience and the relevant work experience. So if they're in the IT space, show what companies they've worked for, what projects they worked on, and just highlight that they are experts in their field in what they're doing. And make sure that you include that board of advisors in the management team as well to show that you've got a well-rounded management team also. And then you want to put a few summary financials in there. And on an executive summary, when we're trying to fit this all on one page, it's just at the very, very high level, such as revenue, costs, and profits for the next 5 years. And if you have a few historical numbers, that can be useful as well. And also you want to show how much funds you are raising and what you're going to do with that money as well. And it's typically not a very detailed use of funds. It's very high level. It's always a mixture of sales and marketing and product development and general administration. But to show you understand how the money is going to be spent, you've got a set of numbers there that describes at just a very high level what's going to happen with it. And finally, what you want to put in there is the exit. Show how you plan to exit the company and return funds back to the investor. And if you're going to sell the company to a larger company through mergers and acquisition, highlight example acquirers. Other companies in your space that have acquired startups, early stage companies, you want to show that there's a history of that going here and that they pay good money for acquiring those companies itself. So if you have any questions, go ahead and type them in. We had one that came in while we were going through this module, and that is, what is a fundraise document? And by that I mean the term sheet and the subscription agreement, and it's the legal documents that go into actually signing up an investment into your deal. And you'll need an attorney to help you put those documents together. And the attorneys know how to structure these deals. They know all the documents that go together. The last time I did a Series A term sheet or deal structure, there was 9 different documents that went into it. And so you want to get an attorney that's familiar with early stage companies and with fundraising, and that'll save you a lot of time when you work with somebody that knows it. And as you start to raise funding, you'll want to be able to have those documents to send out to potential investors for them to review in advance of making a final decision. So that's what a fundraise document is. Are there any other questions? Okay, well, let's press on. If you have questions later, by all means, we can answer those. This is our 4th module, our final one. When we finish here, we'll see if there's any other questions, and then we'll wrap up for the day. So this module is called Building a Team. And one of the critical factors in raising funding, as well as in just running your business, is looking for a complete team. And so what we're doing is trying to figure out, do we have the critical success factors or skill factors for our business? Do we have them recruited onto our team itself? And so we don't have too many people, but we do have enough in order to make it work. If you have an early stage company, you're raising $500,000 and you have 19 people on the payroll, this is going to be a big red flag for the investor. Not many people do that anymore, but that used to be a problem. And so what we're doing now is we're building a core team of somebody building it and someone selling it. Now, as the company grows, this division of labor becomes more sophisticated. And so what you want to do is start to identify future hires to bring on when revenues and funding justify it. So one of the questions investors will have as they're looking at maybe a 2 or 3 person team is, where are you going to find people to fill those roles once you hit that growth rate? Once you raise funding and you're starting to really expand, how will you keep up with the growth? And so what you want to do is put up a team full of potential management team members. So as we grow, we're going to hire a sales and marketing person. We're going to hire a manufacturing person. We're going to hire whatever. And in the pitch sessions, if you see somebody up there with 5, 6, 7 hires in the very early stage, rest assured that those hires are not on board working full-time at full salary. Many of those people are just tangentially tied to the company, and they're going to come on board as the revenues and the funding justify it itself. But what it does is demonstrate that you know who you're going to bring on. You've already identified the right person. They're already attached to the deal in some level, and you're ready to bring them on, and your growth will not be throttled by the fact that you don't have the right people that are going to go into it. What you'll also find is that people that have just directly come from a very large company, the IBMs and the other major vendors out there, are often not quite as helpful or useful as those who are working and living in the startup or early stage world, because the big company people typically have a different approach to the business and to expenditures and to time frames that differs from what we're doing here in the startup world. Because startup skills are very different from big company skills, and you can ask people about that, and I can tell you more offline about how to avoid that. So there's board of advisors, people who help out even though they're not compensated. It's not a board of directors, and the way you build one is just make a list of all the areas you need help with. Go through all the skills that you need to run your business, check mark the ones you have already hired and in your business, and then that which is not checkmarked, go out and recruit one person for each of those skills. 3, 4, 5 is about all you have time to maintain, and then you can add them to the exec summary, and then go spend every other week, spend an hour with them in the coffee shop, and try to gain as much expertise and help from them as you can. And so you can also use it as a technique for recruiting investors and C-level executives. So when someone is out looking for a C-level person or a major investor, one thing I always advise is, well, when you think you found the right person, sign them up on the board of advisors. That just means you ask permission to call them a board of advisor, you put them on the exec summary, but they're not officially signed up, and then go meet with them every week for 2 months. 2 months, have a coffee meeting once a week for an hour, explain to them what your business is all about, and then ask them about themselves and what they're doing and how they could help and so forth. And after 2 months, you'll have a much better understanding of who they are, what they can do, and they'll have a much better understanding of where you are and what you need. And at that point, you can take a decision, yep, this might be a good C-level person for my company, or it's not. So it's a great way to interview people and work with them before you actually pull the trigger and bring them on board. The next part of the team, and it's not often thought of that, but I recommend you think of it this way, is all your service providers are a part of the team. And you want to recruit service providers who know your startup space well, or they know startups well. And you want to find attorneys and accountants and marketers and other people that not only just do the basic legal work or accounting work, but they know something about your space. They have other clients in your space or your size of company, and you can often go to those guys and say, well, how do you solve this particular problem? And they know other companies that they've worked with, so they can actually advise you based on their previous experience with other ones as well. So at this point, let's stop and ask if there are any other questions. We've gone through quite a bit of information, but as I said before, we'll record this session and the slides, and we'll send that to you at the end of the presentation this evening for you to look at. So if you have any questions, go ahead and type them in. Let's see. So the first question here is, where do you go find the appropriate service providers? Well, one thing you can do is ask other entrepreneurs who they're using and do they recommend them or not. I can recommend people as well if you have a specific requirement. You can also, at networking functions and meetings, ask around who might be a good attorney, accountant, or whatever, and you're typically getting good referrals from people who've actually used them before in order to decide if they're a good fit or not. So I would certainly look in that direction. Next question is, where do I find a founding CTO? Well, again, there's some networking and mentoring groups around the area that you can go to try and find someone that might want to join your founding team if you're at the early stage with it. There are groups that actually run networking events built around helping you find other people who will start your company, and offline I can tell you more about where those guys are as well. Question, can advisors come from a potential customer company? Any conflict of interest concerning there? The answer is yes. You can find advisors from your customer base. You'll need to see if your contact there has any conflicts of interest with his company. If you're not compensating them, typically there's no conflict. If you are compensating them, well, then they'll have to look at it and see if there's a conflict of interest that they have with their company. But as you said before, Board of Advisors is a great place to put people without compensation, and then we don't have any conflicts of interest going on in most cases as well. What are the questions? Next question is, when do you build a board of directors? The board of directors comes in when you have actually raised funding. So after when you're in the process of raising funding, it's often the case that you actually build a board of directors. Typically it's 5 people, 2 from the company, 2 from the investors, and 1 who's an independent who often has deep domain knowledge in the industry. And that way you get an equal balance between the company, the investors, and having more industry expertise in the group. And that's your core board of directors, and they come into being when the funding is secured at that point. So if you don't typically need a board of directors before you raise funding. If you do need a board, well, I recommend put a board of advisors together and get people to help you out with your deal. Next question is, do you have to have a management team? You don't have to have a management team, but your chance of your getting funded goes up dramatically if you've got a management team that can handle the business side of it as well as the product or the technical side of it or creative side of it. And it's often the case that people are, they're the technical person, they're the CTO, and when they go to investors, they just call themselves the CEO, thinking, well, I'll just be the CEO and do it myself. But let me tell you, investors spot that a mile away. They know it in an instant if you're really working on the business side of it or you're working on the technical side of it. And if you're working on the technical side and you don't have any business, anyone focused on the business skills, you're going to find it very hard to get funded, and they will push back and they will ask you to go find a proper CEO or a deal maker CEO or a sales CEO or somebody like that that will take care of the business side of it. So I think from a practical point of view, you should really give it a lot of thought. We are S Corp now. Is it okay to wait till the last stage to change to C Corp? It's really a negotiation with your investors. It's often the case that the entrepreneur says, okay, when we go to raise funding, we will switch over, and many investors will accept that and say, okay, later we'll switch to the C Corp, and before my money goes in, you'll be a C Corp, and that's going to be done. So you don't have to pull the trigger in advance. It used to be that you wanted to have a C Corp before you ever talk to investors, but so many show up with an LLC and switch it over later, and it doesn't cost that much that that's really not too much of a red flag with investors today. Say, yeah, we have a plan to switch to C Corp. We're going to do it at this point. So we're not there yet, but it is on our plan as well. Let's see. Other questions here. Got a number that are coming through. Let's see. For the exec summary, how do you fit all that on one page? And the answer is that you're really just giving thumbnail sketches, 1 or 2 sentences on each, bullet points. You're just putting down titles and numbers as opposed to full written out words or full complete sentences. Everything is shortened and condensed down to try to get it on one page. And the reason we want to go for 1 page is that's what most investors will read. They'll read 1 page, but they won't read much more. So whenever I get a 5-page exec summary, well, I hope the good information is on the first page, because the chance that somebody will make it all the way to the 5th page is very, very low in that case. That's why we do it that way. Cost of customer acquisition, how do you calculate that? Okay, the answer to that is you go back and add up your sales and marketing costs. And so if for 3 months I had to pay a salesperson $2,000 a month, for 3 months times 2, that's $6,000. And in that time frame, I also spent $2,000 on marketing, and so I spent basically $12,000, and I generated maybe 50 leads and 10 turned into customers. Well, that $12,000 divided by 10 is my cost of customer acquisition. So just take a period of time, 3, 4, 5 months, a quarter, or 4 months is good, and add up your sales and marketing spend and divide it by the number of customers that signed up, and that's the cost of customer acquisition at a rough level. Let's see, what's the lifetime value of a customer? Okay, the next question is how do you calculate lifetime value? Well, this can be a little bit trickier because customers are using your product at different levels, and so what you want to do is take a number of customers, 10 or 20, and then look at how much they have bought from you over the lifetime that they were with you, and you get some sort of average coming out of it. So if customers bought and used your product for, say, 6 to 8 months on average, then for the most part, then 7 months is the average. You just add up how much the cost of using the product for 7 months, and that's your lifetime value, which is averaged out over some number of customers itself. Those are all the questions we have from now. Like I say, we'll be back a week from today, Friday, 2 o'clock. I'll send you the slides and the recording this evening, and we'll go from there. If you have questions offline about any of the things that we're talking about, by all means drop me an email between now and the next session, or bring your question to the next session and we'll carry into it as well. So with that, we'll go ahead and end it up. Thank you guys for coming out today, and we'll see you next week.